I'm Edward Collins, manager of the Nexus Income Portfolio. So sitting here at the beginning of March, looking back over February, where markets rose impressively by just over 2% and the fund followed suit, which was great to see. Markets were driven by a continuation of the Trump effect. He made his first major speech to Congress, which went down very well, where he talked about massive tax relief for the middle classes, and he was going to ask Congress to spend $1 trillion on infrastructure. So the market got what it wanted as far as that was concerned. On more concrete matters, the Q4 earnings has almost completed, and in the US, which was obviously driving markets at the moment, earnings were up by just under 5% on average, which really was great to see and something that the markets can kick on with this year. UK economic data released during February was largely positive, except for the consumer spending figures, which hardly grew at all. And this has been a major area of growth for the economy. We've been expecting this, which is why we don't really invest in consumer discretionary companies preferring the staples instead, like tobacco and pubs through our holding in Marston's, which has been done very well and has proved to be extremely resilient. And that's what we expect and the kind of things that we want to concentrate on. In February, we saw the US dollar strengthen against sterling, and that's because of a well-flagged interest rate rise in March, which will probably take place. The Fed members have indicated their preference towards, and that's led to a strengthening of the dollar, as I said. But throughout the year, we expect sterling to start to strengthen, driven by inflation expectations here, the fact the economy is robust. And I do expect, as I've said before, interest rate rises in the UK towards the end of the year, so sterling is not going to remain cheap forever. We rebalance the portfolio selectively as we get cash in from our advisors. I'm pleased to say that they've supported us again this month, but we store up cash so that we can reduce transaction charges when we're investing. Company-wise, the fund had a good month, led by Unilever receiving a bid from Kraft Heinz, which was rejected. M&A is a double-edged sword for the fund because obviously it's very flattering when our companies are bid for, but if it goes through, you do lose a good dividend-paying opportunity. This bid was rejected by the management, which we think is a good thing, and will lead to corporate changes at Unilever, maybe a restructuring, which could lead to enhanced shareholder returns. Rio Tinto also announced their results, which really were excellent. We think it's a best-in-class company, and very pleasingly for us, they announced an increase in their dividend, which is what we're expecting. Glaxo also announced good results. Pharmaceuticals had a little bit of a rocky time recently, but these results really affirmed why we invest in the company. And that's because the results were driven by sales of new drugs, which proves that their pipeline is working and that the future growth is going to be there, which the market was pleasantly surprised by. And Lloyds, we've got a large holding in financials in the fund. Lloyds Banking Group announced their results, which are up almost 150% year on year, the profits. The Tier 1 capital ratio is 13.8%, which is very strong and very pleasing to see after the turmoil that the banks have been through that we invest in a really high quality, strong bank. So looking forward to March, it's going to be a busy month for news flow. Obviously we've got the budget coming through from the Chancellor, where most importantly he will announce the Office for Budget Responsibility's forecasts for the economic growth in the UK for the year ahead and give an update on the health of the economy. But also the Prime Minister has announced that Article 50 will be triggered and the process for leaving the EU started, which will be interesting to see. Looking at politics, where Europe is beginning to receive focused attention from the media. There are elections in Holland and in France, where we're watching the polls particularly closely and the results because, of course, polling has a bad track record recently. France is the more important of the two, but it's something that we need to keep an eye on to see if our view of European politics and therefore markets changes, but we're not expecting the unexpected result this time. So in summary, the portfolio remains very robust, highly liquid, investing in the highest possible quality companies with very strong brands that deliver sustainable incomes that are growing. And I expect the portfolio as a whole to deliver a dividend yield in excess of 4%. We'd like to thank our advisors for supporting us again this month, and I look forward to updating you again in March.